Hello everyone, welcome to ACCA P6 UK lectures. We are still at capital gains tax. In this lecture, hopefully we'll finish our capital gains tax. Now we are using the P6 notes in this video lecture. If you could please come to page number 55 of the P6 lecture notes. I won't be sharing the screen with you because most of the stuff is exactly the same which we have already seen in our F6 notes in the previous video lecture. Now, previous video lecture was both for F6 and P6 student, but I was using F6 notes. Same material is given to you in your P6 notes as well, as I mentioned in our previous video. Right, so if you come to page number 55 of your P6 lecture notes, it's a rollover relief. It is exactly the same thing which we have seen in our previous video, as I said. So there is nothing new. Just beneath that, it's a rollover held over relief. It is exactly the same as well. Then we have seen conditions for rollover relief on page number 56, and then after that gift relief just beneath that on gift of business assets and shares of a personal company. Now just beneath that it is a enterprise investment deferral relief. Now whenever we have sold an asset and then we have made a gain on that, if we invest that gain in our EIS years, then that gain would be, the capital gains tax on that would be deferred, so you will not have to pay capital gains tax. So an individual may defer a gain arising on any type of asset if he invests in EIS shares. The amount of gain that can be deferred is the lower of these three things, first of which is the amount of gain that can be deferred is lower of these three things: a gain of the asset, then the amount subscribed in EIS shares, and last one is just useless. It says that amount specified by the investor in his claim. Now if it is up to me to specify in my claim, I would claim as £1 million. If it is up to me, I don't want to pay any tax. So the C thing is it's just a useless option because it is lowest of these three. So obviously my claim won't be the lowest one. I will claim highest amount. So it is lowest of these three. So gain of asset, amount subscribed in EIS shares, and amount specified in my claim. EIS deferral relief should be claimed within 4 years after the end of the tax year when the gain to be deferred arose. So 5th of April 2022 if the disposal in 17-18 tax year, which is our current tax year. Now the deferred gain will become chargeable on either of the following events: whenever we have a chargeable disposal of EIS shares, so the EIS shares which we have bought, when we sell them shares, or the investor becomes non-resident. If I, as an investor who invested in EIS shares, if I become non-resident and the shares cease to be EIS shares, so whichever of these events arise, the deferred gain will become chargeable. On page number 57, incorporation relief. So that is a new relief which is part of P6. It's not in the F6, and we haven't seen in our previous video. So what happens is, when I am running my business as a sole trader, but I want to incorporate my business as a company, so I sell my shares in the company. So in that case, the incorporation relief will arise. Incorporation relief is automatic, so no claim needs to be made. However, an individual can elect not to receive incorporation relief. But the question arises, why would someone not be willing to take a relief? Is there any benefit of not taking the relief? There isn't any benefit of not taking the relief, but some people just think that we will have to pay in the future anyway. We are not avoiding the tax, we are just deferring the tax. So why don't we pay just now instead of paying in the future? It's just a headache. So that's why they can claim not to obtain this incorporation relief, otherwise it will be automatically available. However, if you do so, you will have to tell HMRC by 31st of January, which is approximately 34 months after the end of the tax year, that you do not want to receive this incorporation relief. So when we have all business assets, when we sell, which is our sole trade business, we'll take the sales, which will be cash, and the shares. So we are selling the whole business with cash and the shares as well in that. Then we'll deduct the cost, and then the remaining amount is our gain. Now this gain can be reduced with the help of incorporation relief, but please remember, we have sold shares and the cash. Incorporation relief will only be available on the proportion of shares. So take the gain and multiply by shares over cash plus shares, and it will be deducted, and the remaining amount is going to be chargeable gain. Now when we sell the shares of the company in which we have invested our business, in which we have transferred our business, when we sell the shares of that company, we will calculate the base cost as well. So we'll take sales, then we'll calculate the base cost, and first we'll take the cost and we'll deduct the incorporation relief out of that, and the remaining amount is going to be our gain. Now this incorporation relief is exactly the same which we have calculated in our old business, so it is exactly the same. Right, so the next thing just beneath that is held over relief. We've already seen that. Assets destroyed, we have seen that as well on page number 58, and just beneath that on page number 58 there is a disincorporation relief. Now this disincorporation relief is exactly opposite to the incorporation relief. In incorporation relief, what I'm doing, my sole trade business I'm transferring to the company, and in disincorporation relief the company was fine, we were doing the business, but then we thought instead of running this business as a company, why won't we just make it a partnership or a sole trade business? So when we are doing so, in the absence of this incorporation relief, what would happen is that the company is selling its shares. Now the gain will arise, and that will be chargeable gain. Alright, so with the help of this incorporation relief, it will be different treatment. So this incorporation relief applies when the shareholder decide the company business to be run as sole proprietorship or partnership. Normally, if the company is in disincorporation relief, normally if the company is disincorporated, then for CGT purposes, all the assets sold to its shareholders at the market value, resulting in capital gains chargeable to corporation tax. So normally, in the absence of disincorporation relief, it will be chargeable gain. This capital gains tax can be avoided, exempt, if disincorporation relief is claimed. Disincorporation relief can only be applied if all of the following conditions are fulfilled. So what are these conditions? The business will be sold as a going concern, so we can't sell it on non-going concern basis. So we can't sell the assets separately to different people. We'll sell it as a going concern. All the business assets except cash are transferred. Cash does not need to be transferred. So all the business assets except cash are transferred. All right. Then the total market value of the land and building and goodwill is £100,000 or less than that. All the shareholders to whom the business is transferred held their shares in the company for 12 months prior to the date of transfer. So whenever we are selling these shares to run this business as a sole trader or partnership, we must have, as a shareholder, held these shares for 12 months in the company. And this incorporation relief will apply from 1st of April 2013 to 31st of March 2018, which means from next year there won't be any disincorporation relief, at least in this way. Right, now on the page number 59, it's a gain deferred into depreciating asset. We have seen that as well. Then gift relief in just beneath that. Now when the questions are from question number 60, on page number 60 there is a question of rollover relief. We have already seen that as well in one of the previous videos, or the question was exactly like this. So you will have to revise this chapter so that you can redo these examples as well. So we already have the concept, but we just need to incorporate these rules into these questions so that we can easily do that. All right, so that's it for our capital gains tax. We have finished the notes bit for our capital gains tax. We will do some past exam papers now. Now if you open up your BPP exam kit and open the question number 13 of BPP exam kit, please. Question 13, capstone. Question name is capstone. It was examined in June 2011. So if you have any other exam kit, please open this question, capstone, June 2011. The question was examined. Please remember, do not look at the past papers. If you're following these lectures, I told you a couple of times that do not look at the past papers because they've got old rates, one thing, and the second thing is that they got old rules as well, which are changed every year, almost every year, because it is a taxation paper, so they change in every fiscal year. Right, so capstone, if you read the requirement, we are doing part B of this question and part C. So let's read part B. Explain with supporting calculations in connection with sale of shares in Agrif Limited. So explain with supporting calculations. So we have to explain, we have to write a commentary with supporting calculations. If there are any calculations, we need to do that as well. In connection with the sale of shares in Agrif Limited. So we are selling the shares in Agrif Limited. So we have to make some explanations and we'll do some calculations as well. Now, assuming the tax implications of selling them on 1st of July 2018, so we will sell them on 1st of July 2018. That is first assumption. And the second assumption is that any advantages or disadvantages of to capstone for delaying the sales. If we delay the sales, what would be the consequences? Come to page number 19 of BPP exam kit, so where the question starts. Just look at the last heading of this page, just at the bottom of the page, sale of ordinary shares in Agrif Limited. Capstan subscribed for 18,000 shares in Agrif Limited for £32,000 on 1st of February 2016. So he bought these shares on 1st of February 2016 for £32,000, and the shares are £18,000 in Agrif Limited. He obtained a EIS relief of 9,600 against his income tax liability. Now he obtained EIS relief, so he invested in EIS shares and he obtained a 30% EIS relief. Alright, so we know that EIS relief rate is 30%. So this is £9,600 which the EIS relief was claimed. Capstan intend to sell all of his shares for £20,000 on 1st of July 2018. Now 1st of July 2018 he is intending to sell these shares on 1st of July 2018. When did he buy these shares? He buy these shares on 1st of February 2016. So these are not 3 years. He did not hold the shares for 3 years. If you hold the shares for 3 years, the EIS relief will not be withdrawn. However, if you sell the shares before 3 years, then the share, the EIS relief will be withdrawn, depending on if it is a bargain at arm's length or not bargain at arm's length. Assuming if it is a bargain at arm's length, then we'll take the market value multiplied by 30%, which is the EIS relief rate, as we have seen in our chapter number 1. So assuming it is a bargain at arm's length, we'll take the market value times 30%. So this is the amount which will be withdrawn. This is the amount of relief which will be withdrawn. All right. Right. So then, if it is a not bargain at arm's length, then the whole amount of the relief will be withdrawn. Now, in this case, the market value is £20,000. So rate of relief is 30%. So because he did not hold the shares for 3 years, so EIS relief will be withdrawn. If it is a bargain at arm's length, assuming it is a bargain at arm's length, so he sold the shares for £20,000 multiplied by 30%. So take market value is £20,000 multiplied by 30%. So £6,000 of the relief will be withdrawn. So actual amount of relief was £9,600. Amount of relief withdrawn is £6,000. Remaining amount of relief which he retained was £3,600. All right. So that would be the consequences if he sell the shares on 1st of July 2018. And after that, he says Capstan will relieve the loss arising on shares in the most tax efficient manner. Right. So in part B1, it says tax implications of selling them on 1st of July 2018. So let's do these calculations. What would be the tax implications if we sell the shares on 1st of July 2018? So let's do on the whiteboard. Right. So sale of shares on 1st July 2018. So if we sell the shares on 1st of July 2018, what would be the tax implications? So first of all, we'll take sales proceeds. And sales proceeds in this case are how much has he sold the shares for? £20,000. So £20,000 is the sales proceeds. Then we will have to deduct the cost. Now, cost of the shares. On the first page, if you see, just give me 1 second. On first page, it says that the shares were bought for £32,000 in Agrif Limited. Now, the shares were bought for £32,000. It means that it is a loss. Now, whenever there is a loss on the shares, whenever there is a loss on EIS shares, what would happen is that although the loss is allowable, but the cost will be reduced by the EIS relief originally obtained. All right. Although the loss will be allowable, but the cost will be reduced by the EIS relief originally obtained. Now, if you're not aware of this rule, just go back to chapter number 1 and look at EIS shares and what is its impact on capital gains tax. All right. So whenever we sell the shares of EIS shares, and if it is a loss, doesn't matter if it is after 3 years or before 3 years, if it is a loss, then although the loss will be allowable, but the cost will be reduced by the EIS relief obtained. Now in this case, EIS relief originally obtained was £9,600, but out of that £6,000 is withdrawn because he sold the shares within 3 years. So the amount of relief obtained is £3,600. All right, so the cost will be reduced by £3,600. So that is £32,000 the cost. and EIS relief will be deducted. So EIS relief, and EIS relief, amount of EIS relief was how much? £9,600. 9,600 pounds was EIS relief amount, and out of that we have deducted how much? 20,000 pounds is the sale price times 30%, which means 6,000 pounds is deducted out of that, and which gives me how much? 3,600 pounds. So that is 3,600 pounds which will be deducted out of this one. And if we deduct 3,600 pounds out of the 32,000 pounds, just bear me 1 second, let me do it on the calculator. So the remaining amount is going to be our cost. So 32,000 pounds less 3,600 pounds, that is 28,400. So 28,400 is cost, which gives me the loss of 8,400. So which gives me the loss of 8,400 pounds. So that is a loss. So that is a loss of 8,400 pounds. All right. All right then. Just come to the question again, please. Now, in the requirement, read the requirement again. So it says that tax implications of selling them on 1st of July 2018. In part B1, it says tax implications on selling the shares on 1st of July 2018 with the help of the calculations. We have seen that what these will be the calculations. So we have done the calculation bit. Now you need to write it in commentary style as well. That because if we sell the shares on 1st of July 2018, he did not hold the shares for 3 years, EIS relief will be withdrawn. So if EIS relief will be withdrawn, then for CGT purposes, although the loss will be allowable, but the cost will be reduced by the EIS relief originally obtained. Now, although the amount of EIS relief was 9,600, but because of selling the shares within 3 years period, amount of relief will be withdrawn. How much relief will be withdrawn? Assuming it is a bargain at arm's length, the sale price is £20,000 times 30%, so it is £6,000. So this is the amount of relief which is withdrawn by HM Brethren Custom. So the remaining amount of relief which he retained was how much? £3,600. So this will be withdrawn. This will be deducted out of the cost. So the remaining cost is 28,400, which gives me the loss of 8,400. Now this loss can be set off against capital gains only. Capital losses can only be set off against the capital losses can only be set off against the capital gains. However, because these are EIS shares, please remember, whenever there is an EIS shares, loss on EIS shares can be set off against general income as well. Now, if we would have set it off against the capital gains, maximum we can save the tax is at the rate of 20%. However, if we set it off against the general income, now because he's a rich guy, in the question it says capstone on page number 19 where the question starts. Now the first heading is capstone. It says they expect to have taxable income in the tax year 18-19 of £80,000. So he's a higher rate taxpayer at the rate of 40%. So £8,400 times 40%, that is the amount of £8,400 times 40%. So that is the amount of relief which will be, that is the amount of tax which we will save if we set it off against, just give me 1 second, £8,400 times 40%. So, £8,400 times 40%, that is 3,360. So that's how much we will save the tax, because we can set it off against general income and we will save tax at the rate of 40%. All right, so that would be the excuse me. So that would be the consequences if we sell the shares on 1st of July 2018. Now in the next requirement, if you see, let me just check. So in the requirement B2, it says advantages and disadvantages of capstone of delaying the sales. What would happen if he delays the sales? Now if he delays the sale because he sold on 1st of July 2018 and he bought the shares on 1st of February 2016, so if we keep the shares for 7 more months until 1st of February 2019, then in amount of EIS relief will not be withdrawn. All right, so amount of EIS relief will not be withdrawn, although it will be a benefit if the amount of relief will not be withdrawn. How much is the withdrawn amount? Amount of EIS relief withdrawn is £6,000. So that would be a saving. However, because of this relief of because of this £6,000 not being withdrawn, this loss will reduce as well. All right. How this loss will it reduce? This amount will remain exactly the same. Now, out of this £3,200, £3,600 will not be deducted. However, the full amount, £9,600, will be deducted. All right. If £9,600 will be deducted, of course, it will reduce the cost. If it reduces the cost, of course, it will it will increase the. If it reduces the cost, it will reduce the gain. It reduce the loss as well. All right. So if it reduces the cost, it will reduce the loss as well. All right. So if there is a less cost, there will be less loss. Now, if there is a less loss, if it is not £8,400, if it is the least amount of loss, we will be saving less tax against the general income, because we are setting off this loss against the general income. All right. I hope that you are getting it. Now redo it, please, on your notebook. Please redo this thing. What would happen if we keep the shares until 1st February 2019? So this amount will be same in the cost, because this relief will not be withdrawn. The relief will be exactly the same. So 9,600 will be deducted, or this one. So if 9,600 is deducted, it will reduce the cost. If it reduces the cost, of course, it will reduce the loss as well. If it reduces the loss, then this figure will be lower as well. So we will be saving less tax against general income. So we will be relieving less loss against general income. So that is a downside of it. That is a disadvantage. However, then we'll have to see net effect. So the amount which we have saved, if we delay the sales, amount which we have saved is £6,000. Why? Because this relief will not be withdrawn. So £6,000 less. So what we deduct out of that is that amount of loss. So we'll see that how much is the loss, and against that how much tax we are saving. And what would be another disadvantage? Another disadvantage would be that because we are delaying the sales, of course, whenever we are delaying the sales, we are delaying the receipt as well, which we will receive. So the money coming in, which has to come now, we are delaying it, so we will receive it in the future. That is another downside. And another downside is because this price is £20,000 now, it has reduced substantially. He bought it for £32,000 and it's £20,000 now. Chances are that it might reduce in the future, and if it reduces in the future, there will be further losses as well. All right, so these are the downsides. Now, if you look at part C of the same question, calculate Capston's taxable gains for the tax year 18-19. Right? Now, on the same page, it says sale of loan stock and ordinary shares in Pinblock PLC. Capston will sell £8,000, 7% Pinblock PLC non-convertible loan stock for $10,600. Now, this sales, because it is a qualifying corporate bonds, so it is QCB, qualifying corporate bonds. So these will be exempt for CGT purposes, as we have seen, because it is an exempt asset. Now, Capston will also sell to 12,000 shares in Pinblock PLC for £69,000. We will calculate CGT on that, and the sales will take place on 1st of August 2018. Right? Just beneath that, it says Capston's acquisition of loan stock and ordinary shares in Pinblock PLC. That's how he acquired the shares. Capston purchased 15,000 shares in Vipin PLC for £26,000. So he basically purchased 15,000 shares in Vipin PLC for £26,000 on 1st of May 2010. Then Pinblock PLC acquired 100% of the ordinary shares capital of Vipin PLC on 1st of October 2018. So there was a takeover by another company, which company? Sorry, a Pinblock PLC, which Pinblock PLC acquired the Vipin PLC shares. So in that case, it will give you the loan stock as well, and also on top of that, the shares in the new company Pinblock. Takeover was bona fide commercial reasons and was not for the purposes of avoidance of tax. Now, Capston received £8,000 Pinblock PLC non-convertible loan stocks, a qualifying corporate bond as it says in the question, and £20,000 ordinary shares in Pinblock in exchange for his shares in Vipin PLC. The loan stock and the shares were worth £9,000 and £40,000 respectively, as at 1st of October 2013. Now, this loan stock will not be chargeable disposal for capital gains tax purposes. However, when there is a takeover, on that takeover there will be capital gains tax on that takeover on loan stock as well. Right? So we'll have to make this calculation for this question. Right? So that was this bit here. Now, if you see, if we do the part C of this question, So we'll have to see the capital gains tax. So although that, as I said, that the non-convertible loan stock, these are qualifying corporate bonds on which there will be no capital gains tax, but on the takeover there will be capital gains tax on these loan stocks as well. So how? So that we'll see the the capital gains tax. Capital gain tax on takeover. Right? So loan stock. So what will be the consequences of the loan stock? So we'll take the market value, which is how much? Market value is £9,000. £9,000 is market value. Less we have to deduct the cost. Now this cost we will do working for this cost. Now what would be the working of the cost? So cost. What we have to do is we will take the actual amount of cost which we have with which we have bought the shares in Vipin PLC. So the amount of shares in Vipin PLC, 15,000 shares for £26,000. So that is cost £26,000. And on that, what we got in the new company, so we'll put £9,000 on top, which is the amount of loan stock, and we'll put total amount 9,000 plus £40,000. 9,000 plus £40,000 beneath that, which is £49,000. So £26,000 times £90,000 over 90 over £49,000. That is 4776. And if we deduct 4776 out of this one, 4776 less £9,000, that is 4,224. So that is the amount of that is the capital gain on the loan stock, right? That is the capital gain on the loan stock. Likewise, we'll have to see on the shares as well, right? For shares, we have sold the shares for how much? Let's see. Capital will sell shares 12,000 shares in pin block for £69,000. So for shares, we'll take sales £12,000. Then we will deduct the cost out of that, and for cost we will do working again. That would be working 2, and that is my working 1. And in working 2 we would calculate the cost of this one. So cost. Now total cost was £26,000 for the old shares times £40,000. That is the amount of new shares, and over £49,000 because £40,000 plus £9,000, exactly in the same way. All right. Now again, whatever this figure is, we will have to multiply it by £12,000. Now this is the amount of shares which he is selling in the question, £12,000. The total amount of shares which he got was how many? £20,000 on ordinary shares. So over £20,000. Right. So that would be our cost. So let's do it on the calculator. Just bear me 1 second. So £26,000 times 40 over 49 times 12 over 20, 12,734. So 12,734. So this will be 12,734 will be deducted out of this one. Sorry, this is not the amount of shares. This is the number of shares. Amount of shares was how much? Amount of shares was just bear me 1 second. Sometimes I just lose myself in the question. So it's £69,000. So the sales is £69,000. If we deduct 12,734 out of that, so that would be amount of gain. So let's do it again on the calculator. This is the normally job of a student to tell me the figures of these additions and calculations while I'm in the live class, but I just hated doing on the calculator while in this recorded version. 69,000 less 12,734, 56,266. So that is a gain on shares, right? So the gain on shares, and that is gain on loan stock. And if we total that, that will be our total gain. So what we will have to do is we will take gain And then for loan stock, just give me 1 second. So that is for loan stock, and that is for shares. For loan stock is 4,224, and for gain for shares is 56,266. That is the total amount of gain, total gain. And then we'll have to deduct the annual exempt amount, annual exemption out of that, which is 11,300, I believe. That is 6,490. And if we deduct this one out of 11,300, that is 49,190. Right? Right. So that is our gain, which is our the taxable gain. Right. So so that is end of our this question. I hope that you got it, and please make sure you redo this question because it is your homework as well. If you haven't understood anything out of this question, just drop me an email. I try to elaborate in as much detail as I can, but if you still have any problem, please make sure you just drop me an email and do this question first, then drop me an email. Always remember that before dropping me an email, just try to look at the question clearly and see all these as aspects from every angle. So sometimes you just don't look at the question clearly, they just drop me an email, then you realize, I did mistake myself. So it is always a better idea just to look into the detail, just look at the notes as well, because notes are there for you, notes are there to help you. So always look at the notes as well. Now for this question specifically, please read EIS relief clearly, then you will do this question. So in that case, you will understand it in a better way. And also look at the CGT aspects of EIS relief as well. And then losses which we can relieve against, the loss which we have incurred on the EIS shares, we can relieve against the general income as well. Alright, so that's it for this video. In the next video as well, we will do another question relevant to capital gains tax. Then we will wind up our capital gains tax. I'll see you in the next video then. Goodbye.